Every single day, more than $6 trillion trades hands on the global foreign exchange market. When you add the $109 trillion currently held in global equity markets, the sheer mass of the international financial system begins to come into focus. This constant motion exists to solve a basic economic imbalance. On one side, we have savers and organizations holding idle capital they want to grow. On the other, we have growing businesses and governments that need that same capital to fund their expansion. The financial services sector acts as the primary bridge between these two groups. It is a transmission system designed to move capital from those who have it to those who can use it productively. Without this mechanism acting as the economy's nervous system, companies would struggle to build factories, governments couldn't fund public infrastructure, and the pace of industrial innovation would slow to a crawl. We can break this sector's purpose down into three core functions: the investment chain, managing risk, and payment systems. The first row shows the investment chain, the mechanism matching borrowers with lenders, ensuring capital is allocated to the most productive investments. The second function, risk management, uses insurance and complex derivative contracts to protect businesses and households from global uncertainties, ranging from shifting currency values to major climate events. Finally, payment systems provide the secure rails for money to move quickly and reliably across borders. Platforms like SWIFT allow international trade to function by standardizing how financial information is exchanged between nations. These three functions work in tandem to improve the efficiency of financing decisions. Research shows that as these systems become more sophisticated, they allow a nation to allocate its resources more effectively, directly supporting long-term economic growth. To understand how this capital actually moves, we have to look at the wholesale market. This is the heavy-duty business-to-business tier, where governments, financial institutions, and global corporations operate on a massive scale. Investment banks drive this engine. They provide the specialized expertise needed to engineer corporate mergers, facilitate acquisitions, and help companies raise millions in new capital by issuing shares or bonds to institutional investors. These banks often work with pension funds, massive pools of long-term capital built from employee contributions. Because these funds invest for decades, they provide the enormous, steady liquidity required to sustain global equity markets and large-scale property developments. Behind the scenes, custodians handle the practical details. These specialized institutions don't decide where to invest. Instead, they focus on the safekeeping of assets, the settlement of trades, and the collection of income for the funds they serve. This wholesale infrastructure provides the underlying funding and liquidity that eventually filters down into the retail markets the public uses every day. The retail market serves as the translation layer. Here, the massive capital flows of the wholesale world are converted into accessible financial products for individuals and small businesses. The retail landscape is divided between traditional commercial banks, owned by shareholders, and specialized savings institutions. These are often mutual societies, jointly owned by their members. Over time, many have undergone demutualization, converting into traditional banks quoted on stock exchanges. You also have consumer finance companies. Unlike banks, they don't take deposits. Instead, they raise money from banks and capital markets to provide specific services, like financing a car purchase or helping a business manage its cash flow by purchasing its unpaid invoices at a discount. The retail market turns macroeconomic capital into the specific mortgages, savings accounts, and personal loans that define individual financial lives. Wealth management takes these services a step further, integrating investment strategy with tax planning and estate management to help clients meet long-term financial goals. The industry segments these services based on total investable assets. This ranges from the mass affluent at $100,000 up through high net worth individuals to the ultra-high net worth tier, those holding over $30 million in assets. While standard advisors serve the broader public, specialized private banks and family offices focus exclusively on these higher tiers. A single family office might act as a dedicated advisor for just one family, managing everything from their private investments to their philanthropic foundations. In these tiers, the level of control varies. Discretionary management allows a manager to make and execute decisions within agreed parameters, while advisory management requires the client to approve every transaction before it occurs. At the highest levels, the focus shifts toward a multi-generational strategy, integrating tax efficiency and estate planning to preserve a family's economic influence across several decades. The traditional boundaries between these sectors are now shifting. Rapid technological change is disrupting the role of traditional gatekeepers and opening the system to new types of participants. Peer-to-peer lending, for instance, connects savers directly with borrowers. By cutting out the bank and the interest rate spread they usually keep, these platforms can offer lower rates to borrowers and higher returns to savers. This has been accompanied by the rise of shadow banking, a network of non-bank institutions that provide credit and liquidity similar to traditional banks, but often operate outside the same regulatory frameworks, presenting new risks to the financial system. In the developing world, mobile technology is bypassing physical infrastructure altogether. In parts of Africa and Asia, smartphones allow previously unbanked populations to access secure payment systems and digital financial products for the first time. Even professional wealth management is becoming automated. Robo-advisors use algorithms to analyze a client's data and implement investment strategies without a human advisor, providing a low-cost entry point for investors who prefer a digital-first approach. As these digital platforms remove traditional intermediaries and give individuals direct control over their assets, the responsibility for managing risk has shifted to the user. Successfully navigating this evolving network now requires a deeper understanding of how these new tools and less regulated systems actually function.